A huge amount going on within financial markets at the moment, and that's going to continue apace. Certainly, the week ahead of us continues to see a raft of key events to watch out for on the economic front, with the likes of the ECB, the Bank of England, and the RBA all enacting their monetary policy decisions alongside jobs data coming out of the US on Friday. So first and foremost, as ever, we'll look at the economic calendar to see the big ticket items that we've got ahead of us on Monday. The manufacturing PMI out of China, manufacturing ISM PMI out of the US. Then overnight into Tuesday, we've got the RBA interest rate decision. This is going to be probably the most interesting of the lot because we've got an expectation of a 25 basis point hike from the RBA, flying in the face of many of the other central banks that, of course, have been easing. We'll get into that. JOLTS job openings data kicks off the focus on US jobs for the week. Then we've got inflation out of the Eurozone, the ISM services PMI out of the US. We've got the rate decisions from the Bank of England and the ECB on Thursday, and we round off the week with jobs data from Canada and from the US. So let's kick off with the US. This is the data for the week ahead. As we see, really the big ticket items going to come in the format of Friday's jobs report. The expectation is yet another week reading of 40,000 on the non-farm payrolls reading and a rise in unemployment. Will that make any tangible difference to markets? Certainly, I think, depending on who you ask, some people will say markets don't care about economic data at the moment. And some people will say, well, that reiterates the need for the Fed to actually act in a swifter manner. Now, we have just come off the back of an FOMC meeting where they opted to vote 10-2 in favor of keeping rates steady. And Jerome Powell essentially said, well, it's all because of tariffs that we're seeing as inflation and it's too high. If we see inflation come down, then yeah, maybe we'll be able to act, knowing full well that he probably won't act until he's moved out of the position in May. But nonetheless, we'll try and go into the sort of nuts and bolts of sort of whether markets really care about this or not. So one thing worth noting is this relationship that you see typically between the non-farm payrolls and the value of the US dollar, i.e. if you see a weakening of the US economy, there is a perception that the Federal Reserve will need to act, and generally you will see a weaker dollar in response to those expectations. Now, it's not a guaranteed that that's what's going to happen. Now, bear in mind, over the course of the past week, we have seen, of course, talk about the Federal Reserve holding off for a few months, potentially the next rate cut coming in June. That doesn't necessarily scream a desire to cut rates and the need to weaken the US dollar, but nonetheless, the dollar plummeted. And part of that came off the back of comments from Donald Trump, who's essentially said that he likes a weaker dollar. Part of it is a breakdown in relations with other countries around the world and a feeling that the US dollar is losing its reserve status. And part of it is sort of rounded up in this. So instead of comparing, say, the 2-year yield to the US dollar, which would be a reflection of an expectation of where rates are going to go over the next couple of years versus the dollar, i.e. if we have a more dovish outlook from the Federal Reserve, it causes a weak dollar. Instead of doing that, what I've done here is I've given you the differential between the short end of the curve in terms of bonds and the long end of the curve. The short end of the curve gives you a reflection of where people think rates are going to go under the Federal Reserve. So we've got that side of the story. The long end of the curve, the 30-year, points towards people's desire to buy into the US, given the perception of stability or instability that's inherent within the US at the moment. If we see a massive rise in terms of debt, as we're seeing over in the US, if we see unstable economic conditions that people get worried about and don't necessarily want to buy into US treasuries, that means yields have to rise. So the two of them hand in hand are two of the main factors driving the US dollar lower. If you have a loss of confidence in the US and the US sort of structures, financial structures, and the ability for people to continue to invest in US treasuries, then yields go up. But if you have an expectation of a weaker level in terms of rates from the Federal Reserve over the near term, so a more dovish outlook from the Federal Reserve, i.e. weak data, as we see with this jobs report, then we see a decline in terms of, say, the 2-year. So then that yield differential grows. So you can see a move from one side or the other. So when people are saying, well, people don't care about what's happening with the jobs, they care about what's happening in terms of the loss of confidence or the rise of debt. Well, in actual fact, this relationship between the two ends of the curve gives you a bit of both. You can see movement on the short end of the curve, say expectations around the Fed, and that moves the line. You can see it on the opposite end of the curve, where sort of the perception of the US economy, the strength of their economy, the relationships they have around the world, that moves the 30-year. So that's what's particularly powerful about this. Now, I'm just going to remove gold from this. Let's look first and foremost at the US dollar, and you can see that relationship here, particularly strong throughout Donald Trump's tenure, and it's starting to roll over once again. That yield sort of, in essence, the US dollar has sort of front run it to a large degree, because we saw that sharp decline in terms of the greenback. This is the dollar index that we're looking at here. So what this is to say is, if we see weakness in terms of the jobs report to the extent where people start to price in additional, so I realize that I'm showing you a different chart from what I'm looking at here. So yeah, basically you can see the US dollar has front run it, but essentially what we're looking at here is that the idea is, if we see weakness in terms of the jobs data to the extent where it shifts expectations around the Federal Reserve's near-term easing pathway, that leads to a weaker dollar. If we see a stronger economic sort of outlook following a better than expected jobs report, high payrolls number, decline in terms of unemployment, things like that, that could lift the 2-year yield, signal a more patient approach from the Federal Reserve, and potentially lift the US dollar as a result. This is the outlook in terms of the Fed going forward. Of course, we've just seen a pause. Now, markets expect a pause in the next 2 meetings. And then essentially you've got something like a 61% chance of a rate cut for the first meeting of the new Fed chair in June. Whether that comes to fruition or not remains to be seen. And that will likely be data dependent. So in actual fact, if you're looking for shifts in terms of expectation, you're probably not going to get a rate cut under Powell. You're probably looking at whether the new Fed chair is going to be able to essentially convince the Fed members that they need to cut in June when they come in, and certainly a weaker economic outlook would play into that as well. So let's just jump onto this first and foremost in terms of that chart, which is exactly what I showed you, but in a different format. So we're looking at the possibility of weakness in terms of the jobs report. That would point towards further downside. We've seen this decline thus far in terms of the US dollar index. We're seeing some stabilization. Scott Besson, for one thing, has come out saying that we don't target a lower US dollar. We actually like a strong dollar. Yeah. Heard it all before. I mean, they don't necessarily want to say that they want a weak dollar, but, you know, Trump said it. It's pretty obvious that that's been the plan all along. Because he complains anytime anyone else has a weak currency against the US dollar. The wider context here does show you that we have this perception that this could be a retracement before the bulls come back into play. And worth noting, you know, when you overlay the first 4 years of Donald Trump being in power over this current tenure, it does point towards a possibility of a bottom coming in for the US dollar in the not too distant future. However, we'll play it by ear, and certainly towards the downside, you have got this 76.4 fib, which is around 95.2. So if we rebound from that level, really we'd need to see a break up through your near-term resistance, which will come at sort of 100.4. Over the near term, of course, the bears are in charge. You have got the possibility of some sort of retracement coming into play, and particularly if we do see a stronger than expected jobs report, it would play into that narrative. In terms of the price of gold, let me just put that onto this chart as well. And you can see here, it's not perfect, but certainly there is a relationship with it as well. And certainly the US dollar, the weakness of the US dollar is one of the narratives that plays into gold. And also the idea, you know, certainly when we're talking about those two aspects of the 2-year versus 30-year, that plays into it as well, because you've got the idea of additional rate cuts, good for gold. So lower short-term rates, good for gold. Concern around the stability of the US as a place to do business and a place to invest in treasuries. Well, that's good for gold, because gold is the alternative haven asset that people appear to be moving into now. Central banks around the world favoring gold over US treasuries. So certainly that's a key one to be looking out for over the near term as well. Of course, gold continues to push higher, silver continues to push higher. Notably, as I record this, we're seeing a sharp rise in terms of some of the other metals that are being stockpiled, and we expect to see supply squeezes over the coming years, notably the likes of copper, the likes of aluminium, tin, and alike. So commodity space, absolutely crucial at the moment. And yeah, I think, bearing in mind, I've of course inverted this gold chart. So that's the reality of the situation. The key thing here is that we keep sort of seeing short consolidation and shallow consolidation before the bulls come back into play, which obviously shows that it's a very strong bullish trend in play at the moment until we break down through the prior swing low. It's just a case of sort of following that trend. Next up, let's look at Australia, a really interesting one, because of course markets are pricing a rate hike from the RBA, and that takes place on Tuesday, depending on where you are in the world, really. Could be Monday, could be Tuesday. Essentially, where I am in the world, which is in the UK, it's 3:30 a.m. So I shall not be following it live, but nonetheless, I'll be expecting to see some price action from the Australian dollar in the lead up to it anyway. And this is why you can see that the data is a little sparse, because I've only more recently moved from a quarterly inflation gauge to a monthly inflation gauge. Good news for me, because I get to see more data, and you can see the most recent monthly figure came in at 1%, boosting their annual figure up to 3.8% on the headline number, or 3.76, as you see from this chart. So inflation's a problem, and they're having to address it. Markets expecting a 70% chance or 69% chance of a hike. Beyond that, the possibility of a second hike later on in the year, but really that's probably going to be data dependent. In terms of the outlook, in terms of the Australian dollar, of course, you can sort of counteract the idea of a weak US dollar against the idea of a strong Australian dollar if they're going to be hiking rates. And that's exactly what's been playing out. You see this big burst higher over the course of the past couple of weeks. Let's look on a monthly time frame. You can see here long-term trend is bearish, but now that we've broken up through this swing high that comes in here, 694, that does point towards a possibility of a breakout from this trend that's been dominating the past maybe 4 years, 5 years, and the possibility of further upside to come. I'd probably say look out for this on the sort of intraday short-term basis because of that. And it's just a case of just like looking out for these swing lows, really. I'm trying to see if there's trendline support. It doesn't really matter all that much, quite frankly. It's just, like we said before, you want to try and find these key swing lows and just try and see if you continue to see this sort of stepped move higher, then it's a lovely trend. And it looks like we're heading in that same direction at the moment. So unless we break down through, at the moment, 697, but if we break up through resistance, then I'd be shifting that stop loss area down to 702. When you break through those swing lows, then that tells you something about this trend and the possibility of it rolling over. But until that happens, this bullish trend does still remain in play, particularly if the RBA do hike rates, and crucially, if they open the door to another rate hike later on in the year. And finally, let's look at the UK and the ECB. So I've put Europe, and we've got inflation data coming out on Wednesday from the ECB, starting to move a little bit higher, but it's still roughly there or thereabouts in terms of around target. Retail sales as well on Thursday, but really it's all happening on Thursday with the Bank of England and ECB interest rate decisions. The expectation is nothing from either, and in actual fact, something that I've been talking about over for a long time now, is the idea that we could potentially see sort of euro sterling rise when we see the Bank of England start to cut rates at a meaningful manner once again. You can see in terms of the ECB, markets expecting very little, 20% chance that we see any cut this year. But the UK, let's see, the UK rates expected to be cut maybe in April, and then beyond that, maybe a toss up for another one later on in the year. So maybe 1.5 cuts being priced in. And this is really key to it, because when we're talking about rate cuts, you could say, well, right now we're above 3% in UK inflation. Why would the Bank of England cut rates? And that's likely part of the reason why we're seeing some strength in terms of the pound. However, as I have reiterated many a time, look beyond the February, March, and April figures. They're absolutely massive monthly figures. When they get stripped out, UK inflation is going to drop like a stone. And you can see here 8-month annualized figures. So essentially, if you took the last 8 months, which is stripping out everything up until that April reading, last 8 months are tracking at a pace of 2.1% of both core and headline inflation. So a return to target looks very likely, and it could happen in Q2 of this year. And that provides the basis for the Bank of England to do exactly what they want if they deem it necessary. Might need to cut rates with a view to bringing down borrowing costs, because the pressure is starting to pile once again on Rachel Reeves as UK yields push higher once again. It's just a thankless task that she's got there. So yeah, let's just look in terms of that euro sterling move, because it's sort of reversing at the moment. So this is something I have talked about in the past. Because of the fact that it's going to take a bit of time for this data to really come through. Like I said, it's going to be probably Q2 that we see the inflation back down to target. It's a possibility that we don't necessarily see markets sort of front run it, and instead, because we've seen such a strong move higher, we're now starting to see some weakness coming into play, particularly if we break through this 859 and it points towards further downside to come. I think it's probably the case of just following the trend, and at the moment you're looking at a more bearish outlook for this market. You can see here these sort of swing highs coming into play. So 8745, the current major one, and then you've got this sort of shorter term patterns coming into play at the moment, sort of trying to break through this zone of support between 864 and 865. So potential head and shoulders formation here could point towards further downside. The outlook from the Bank of England, they're not likely to cut, but a serious move of disinflation is around the corner. The question mark here is whether markets care about it right now. And at the moment, it doesn't necessarily look that way. If we do see a more dovish outlook from the Bank of England, highlighting that potential disinflationary move and how it could impact their expectations, then that could move things over the near term. But for the time being, it seems like we're seeing a breather to that bullish trend that played out throughout pretty much the entirety of 2025. But I do think that's likely to return. The bulls will return. It's just a question of when, and it's going to take a bit of time for this data to flush through. So yeah, an interesting one to watch. I think it's a case of just looking out for those swing highs. Once again, 8745 is the current resistance level that needs to be broken to sort of end this sell-off that's been taking place since that peak that we had in mid-November. I hope that's been useful for you guys. Make sure to like, subscribe, and follow for more. I'll try to make sure that I'm not keeping abreast, because I'm constantly providing updates. Make sure that you get onto our Twitter account, Telegram. We've got all sorts. But yeah, I need to do some other breakdowns for some of these other areas. Uranium, copper, I've done a lot of gold and silver. I've done the US dollar and the implications for that, trying to cover it. But there's so much interesting stuff going on at the moment. It's great. But this at least has been an outlook for a very busy week ahead when it comes to economic data. Thanks a lot, guys. Join me next time. Thank you.